SoFi has 2 free ETFs that have a 0 expense ratio fee. Well, actually, they have a fee, but it's been waived until, I believe it's 2000. They have a fee that's been waived until June 30th, 2023. So the 2 funds that SoFi has, they've got a Select 500 Index ETF, and they have a SoFi Next 500 ETF. The first one is basically sort of like the Vanguard S&P 500 fund, except it's not completely the same. So the Vanguard S&P 500 fund is weighted based on the market capitalization or the value of the companies, whereas the SFY, the SoFi Select 500, is based on that plus three key growth signals, including sales growth, revenue growth, and forward-looking revenue estimates. So they look at the 12-month sales growth, trailing 12-month sales growth, the trailing 12-month earnings per share growth, and the 12-month forward-looking earnings per share growth consensus estimate. And the same goes with the 500 Next index. It's the same thing, but they're doing it with mid-cap stocks, not the large cap. What do I think about this fund? So Vanguard has been around for a long time. The fee for the S&P 500 fund is like 0.03%. You can also get, I believe it's Fidelity has one from iShares, IVV, which is 0.03. And I think Charles Schwab may be even cheaper. They've got one that's, I don't think it's similar to the S&P 500. It's a broad market fund, and I think it's 0.02. Those are all huge companies that have been in the investment business for a long time. So how long has SoFi been in this business? Well, they launched this in 2019. They launched these both of these funds, and they're actually they're not doing it by themselves. They don't have any experience as a financial advisor. So the financial advisor has a financial advisor. So SoFi is using Torosco Investments LLC as an advisor for the funds. They basically do the execution every once in a while. I think every year they've got to rebalance after the S&P 500 people decide what stocks they want to add or remove. Well, anyways, they do the execution or supervision of SoFi. So the 2 companies have some sort of arrangement together where I guess SoFi does the marketing and the some of the customer service, and then Torosco does the technical stuff in the back end. And they're the ones that set Toroso is the one that sets the fee, and they're the ones that have agreed to waive the fee until 2023 June 30th. And I believe the fee is 0.19%. So once it kicks in, it's quite a bit higher than the big guys like Vanguard and Fidelity. You know, if somebody's looking for an ETF, if you're looking for an ETF to invest in, wouldn't you want to have an investment advisor that has the experience to be able to do it themselves rather than have to bring in a third party? I think, I don't blame them for doing it. They're new, and, it's probably better that they do that than to go it alone. But that just says a lot about the lack of experience. So the Vanguard S&P 500 fund, VOO, the inception date of the fund was 2010. The SFY, the inception date was 2019. Vanguard created the world's first index mutual fund in 1975. In 1981, they introduced the Vanguard 500 Index Fund, now 44 years later. And they have trillions of dollars of assets under management. So this SFY I believe it's less than $100 million. I know the second fund is like $60 million. SFY has a market cap. SFY has a market cap of $391 million. And you know what Vanguard VOO has a market cap of? They have a market cap of $747 billion. Even if you went with the Vanguard total stock market, if you went with the Vanguard total stock index, that's $1.15 trillion. Okay, now if you wanted to go with Fidelity instead and do their iShares fund, Fidelity IVV has a market cap of $294 billion. So that'll give you an idea of the difference. So what's the problem with being small and inexperienced? Well, I'll tell you. And you've got the volume. You have no history of managing money, so they could make mistakes. There's the tracking of, they actually created their own index. That's another concern. And the index, they're really the only ones that use this index. So both of the funds use their own index. And they've used a third-party company to come up with the index. But even tracking that index, the error rate is higher than what Vanguard has. So when I looked it up, I think it was 0.06 or 0.09, the tracking error. That has to do with how closely it tracks the index, whereas the Vanguard VOO was like 0.01 or 0.02. So that's one thing. And then it's not just that. There's actually a third company involved. So with Vanguard, you're dealing with one company. You're not dealing with an investment advisor for your investment advisor, right? This one, you also have, they have a third company that is doing the distribution. So it says SoFi ETFs are distributed by Foreside Fund Services LLC. That's the third company they have. So if for some reason there's an argument or some type of dispute, now you've got three companies involved instead of just one. So that's something I don't like. Also, this company that SoFi is going through, Torosco, which I've never heard of, they have other ETFs that they sell. They have other ETFs that they offer. You know what the average ETF fee is for their average fund? It's 0.75%. And that's really high. That's way more than what Vanguard or Fidelity or Schwab charge. So what that tells me is if at some point in the future, if there's a financial issue, and SoFi is struggling, which they are, or they will be in 2023 and 24, and I'll explain that. If they're struggling and Torosco needs to make up the money, they're probably going to revert back to the fee that they're used to, the 0.75 fee, or SoFi will be forced to sort of pass on those fees or change the fee structure because their financial situation is not doing so well. So SoFi has been losing money for like 4 straight years. They've been offering these huge promotions to gain customers, and in 1 year they've lost like $400 million, and their cash flow in 1 year was like minus $6 billion. So they've been losing money for a long time, and the way they manage it is they can sell shares to raise money, and they can raise money by borrowing money. And the problem we have now is interest rates have gone up, so their borrowing costs are going to go up. Another issue is their stock price has fallen about 85% from its peak. So the problem with the low stock price is it's very difficult to raise money. So they have to sell those shares on the open market. And when the shares were at, its share price was at $16.90. No, actually, if you go back to 2021, they were at $25 a share. Now it's $4.70 a share. So before, they were able to sell shares on the market and get $25 for each of those shares that they issue. Now they're only going to get $4.70. And if they start offering too many shares, the share price is going to go down even more. So they're going to be struggling to raise money, and they're going to have to make cuts. And I think that's going to be all cuts to all these YouTubers you see promoting SoFi. All the promotions like the $200 sign up for a checking account. All that stuff's going to disappear. And these no fee, zero fee ETFs that don't make any money, they're going to have to cancel that because they're losing money on it and they're struggling with finances. So I think that's what's going to happen in 2023 and possibly 2024. And I'm not saying that they're going to go out of business. What I'm saying is they're going to have to make cutbacks. So they've got, I think, $1.5 billion cash the last quarter. That's probably more than enough to last them through 2023. But they can't keep doing the spending that they're doing. So that's why I think the 0% thing is going to end. So you shouldn't even think about the 0%. You should be thinking, if you get into this fund and you were in it and you're going to be in it for 10 years, think about 0.19% or 0.75% fee, because that's probably going to be closer to the reality. And also a zero fee is just not sustainable. So with an ETF, it's a portable instrument that can be transferred from any broker to broker. There's no locking in. So Fidelity can get away with it with their zero fee mutual fund because they make it where you can't convert it, you can't transmit it from one broker to another. You're stuck in their ecosystem. Then they can sell you other stuff. That sort of makes sense. They can upsell you on this and that and make money in other ways. With an ETF, you can't do it. So this 0%, I think, is just to get people's foot in the door. They're hoping that it'll become popular like VOO, like Vanguard's VOO, or some of the other big funds. They're hoping it'll take off, and then at some point, they plan on increasing the fee. That's what I'm thinking. That's the only thing that makes sense to me. You know, I don't want to be too pessimistic with SoFi. I mean, I know a lot of people like the company, and you know, they have a credit card and a bank account. I wouldn't hesitate for a moment to sign up with one of those. Even though I do have some reservations with their marketing. However, I wouldn't hesitate because they're protected by the FDIC. So even if they're in poor financial shape, you don't have to worry about it. Everything's going to work as it normally does. The bank account will stay open. Your bank balances will be fine. It's not like the money's going to disappear like it's Bitcoin. So banks have been taken over by the FTC all the time, and a lot of customers don't even know they've been taken over. Sometimes they may have a day where there's a sign on the door and the bank's shut down temporarily, but most of that stuff's done in the back end. And the same, I've had a credit card before that was taken over by the FDIC. It was one of Amazon's first credit cards, and it was also a San Francisco startup called Next Card. Just like SoFi, it was a San Francisco startup. And just like SoFi, they spent an enormous amount of money acquiring customers, way more than than their peer groups. And eventually they spent too much money on internet ads gaining customers, and they lost too much money with bad loans. And they eventually got taken over by the FDIC. And, you know, I could still use the card for a while, and before I think I eventually got converted to something else or shut down completely. But, you know, it's not like you're going to lose money or anything. So, you know, don't be afraid of signing up with one of their other services. But with an investment, it's more long-term nature. So you're investing for probably more than a year. And there's a good chance that they could go out of business in that time. And things could change in that time. The fee could change. All of that stuff could change. You don't want to be stuck with something that's grown to 10, 20, 30, maybe $100,000. And then it's going to cost you a lot of money to get out if you have to sell and have capital gains. And it's just not worth the hassle. So that's the main issue. The low market, the poor performance, they're actually under, even with all this fancy stuff with the earnings per share and sales growth, trying to pick the high growing companies, they've underperformed VOO by several percentage points over the 2 years that I pulled up. So they underperformed that, and the mid cap underperformed the Vanguard. Both there's two Vanguard mid caps. It underperformed both of them. The other thing is the volume is so low since it's a small market cap. It's basically like this. Imagine going to a party, and you're going to imagine going to a marketplace, and you're going to buy a new car, and there's one dealer. So SoFi is basically like, hey, we're not going to charge you a fee for this fund. So it's like going to a small town that has one dealer and doing a deal with that dealer. And so if you agree to a $30,000 price on the car, the dealer wants, let's say, $31,000, and then you end up settling in the middle. You pay $500 more. He gets $500 less than what he really wants, but you've settled. That's the sort of the spread, the bid and the ask price. Now imagine a company like Vanguard. It's like going to a party with the full room of people, and they're all willing to do deals. So it's like going to a big city, but you're going to a marketplace to buy a car, but there's like 10 or 20 dealers there, all selling the same car. So you've got 10 or 20 dealers all offering different prices, but you have to pay a 0.04% fee to get in. But once you get in, you want to pay $31,000 or $30,000 for the car. Another dealer wants to offer for $31,000. Another one wants to offer it for $30,500. Another one does $30,250. And then maybe you've got one that's even closer. So you settle on one that's like $100 more, and you split the difference. So you end up paying $50 more. You end up paying $50 more than the price that you really wanted. But that's still, you've saved way more money than let's say with SoFi, where you've got one dealer and you've got a high spread. That's basically like the spread. So your ETF is like a stock. So if it's not widely traded, you're going to have a wide spread. So when you go to buy it, you may have to wait a while for the execution to happen, and you're going to pay a higher price. You're going to buy it at a higher price, and you're going to sell it at a lower price. That's what happens. So that tiny little fee is going to disappear right away, right when you go to buy and sell. And that's the problem with ETFs that aren't popular. So it's a popularity contest, and the popular ones, unfortunately in this case, they sort of win. And that's just the way it is. And you've got a higher tracking error. So I don't know what causes the tracking error, but for whatever reason, they don't have enough volume or turnover or whatever to, for whatever reason, the tracking error is much higher. So they don't perform as closely to the index as what like Vanguard does. So that's another concern. So when you add those factors together and the poor performance, I wouldn't take a chance on SoFi. I would stick with Vanguard or one of those Charles Schwab ETFs or Fidelity. Do one of the big low-cost ones. Nothing fancy. All of the ones that you would think would do better. They've all these specialized ETFs. They have a really high fee, and they never pay for themselves. So even the S&P 500, the equal weight ETFs, you would think that maybe those would do better because they don't have everything in Apple and Microsoft. They've got a lot invested equally with the smaller companies. You would think that those would do better, but I haven't seen any of those that have done better than VOO or any of the generic S&P 500 funds. So that would be my suggestion, is to stick with the generic, stick with the boring, the ones that your parents and grandparents tell you to invest in. Those are the ones that you want to be in, not some new high-flying company that's burning through money left and right. And that's also that SoFi has a questionable history. They've been sued for fraudulent marketing to the student loans. So they were advertising that these students would have huge savings on their student loans, and it failed to materialize. And a lot of these people that got the loans sued. There was a class action lawsuit, and then there was some type of settlement, I think, with the FTC. And I also recently, when I was looking at their checking account, they've since updated the website, but when I was looking at their checking account, it said checking all over the front page, and it said 3%. And I was looking at it, and it said 3%. And then it wasn't until I started reading the fine details that the 3% was for the 3% was for the savings account portion. The checking account portion was 2.5%, and that's if you met a bunch of different criteria like direct deposit. Which I found that was sort of deceptive. So if they're already being deceptive, they've already had a history of being deceptive one way. I have a feeling that the way the fund is run, as far as the fees, that could easily change in the future. So that's one thing. And luckily, they've changed their checking account now, where it's crystal clear that the 3 or 3 point, I think it's more than 3 now, the 3% rate is applies just to the savings account. But for a while, they had it where it was very deceptive. So that's a concern I have with them. So I'd say stick with Vanguard. Don't waste your time with SoFi. Maybe in 10 or 20 years, if they have $1 billion in the fund and it's doing better than Vanguard, then go with them. But until then, stick with Vanguard. Okay, have a good one.